All right, let's dive straight into this explainer. I want you to picture the entire global economy as this massively complex, high-performance vehicle. Millions of moving parts, constantly humming along, sometimes accelerating way too fast, and other times just kind of sputtering. Well, today, we're climbing right into the passenger seat to decode the mechanics of monetary policy, and we're going to see exactly how this incredibly powerful engine is actually controlled. Because it's a huge question, right? Who actually controls the value of the cash in your pocket? When you grab a coffee or pay your rent, you are completely relying on that currency holding its value over time. But in a modern world of fiat money, meaning money that isn't backed by a physical commodity like gold or silver, its value relies entirely on trust and some really carefully calibrated control. I mean, if the supply of that money is just expanded indefinitely, its purchasing power absolutely plummets. So the stakes here are incredibly high, which makes this seemingly abstract concept of money deeply, deeply personal to all of us. So here is our roadmap for today. We're going to meet the central bank, look at their monetary policy toolkit, explore the transmission mechanism, talk about building credibility, see how they steer the economy, and finally, look at the limits of monetary policy.
Okay, part one. Let's meet the central bank.
Essentially, the driver of this economic engine.
These institutions actually wear an absolute ton of hats. First and foremost, they are the monopoly supplier of domestic currency. No one else is legally allowed to print the money. If you or I try it, we're going to jail. They also act as the banker to the government and to regular commercial banks. And this is crucial, they are the lender of last resort. Meaning, if a commercial bank faces a sudden crisis, like a bank run, the central bank stands ready to step in and provide emergency liquidity. They also oversee the complex payment systems we use every single day, and they supervise the broader banking system to keep it robust. But their highest profile role, by far, and what we're focusing on today, is acting as the conductor of monetary policy. So, with all those different jobs, what is their ultimate destination? Well, if you look at the mandates of central banks around the world, from the European Central Bank to the Bank of Korea, they almost all share one overarching goal: price stability. They want an economic environment where inflation is low on average and just steady. And why does that matter so much? Because in a stable environment, regular households feel secure making consumption and saving decisions. Corporations can confidently invest and grow without the constant fear of massive, unpredictable economic booms followed by devastating busts.
Moving on to part two, the monetary policy toolkit. These are the pedals and levers they use.
To actually tweak the money supply, central banks rely on a sequence of three main mechanical interventions: open market operations, setting the policy rate, and establishing reserve requirements, which literally dictates how much cash a bank is forced to keep locked in its vault. Let's start with open market operations. This is one of the most direct ways to change the amount of money floating around in circulation. It involves the central bank buying or selling government bonds from commercial banks. When the central bank buys bonds, it credits those commercial banks with fresh reserves. It's literally injecting new fuel right into the system, which the banks can then lend out to consumers and businesses. But conversely, if the central bank wants to slow things down, they do the opposite. They sell bonds to the banks, draining their reserves and immediately reducing their capacity to create credit. Then we have the policy rate. You hear about this in the news constantly, right? It's the most obvious expression of what a central bank is trying to do. It's simply the official rate at which the central bank is willing to lend short-term money to commercial banks. In the UK, that might be a 2-week repo rate. In the US, it's the discount rate and the targeted Fed funds rate. By setting this base rate, the central bank essentially forces commercial banks to adjust their own lending rates. Because think about it, a bank isn't going to lend you money at a lower rate than what it costs them to borrow it. So raising the policy rate makes all borrowing in the whole economy more expensive, which cools down spending. And if the central bank wants to restrict things even further without actually touching that rate, they pull out that third tool, raising reserve requirements. That forces banks to sit on their cash instead of lending it out.
All right, part three, the transmission mechanism. Let's take a look under the hood.
This is where we see the domino effect in action. The central bank flicks that very first domino, the official rate, and that creates this massive ripple effect across 4 distinct channels. First, it hits market rates, immediately making things like your mortgage or your credit card more expensive. Second, it shifts asset prices. For instance, higher rates might cool down a red-hot stock market or housing prices. Third, it completely alters public expectations and confidence. And fourth, it impacts the exchange rate. Usually, if a country raises its rates, its currency strengthens. That makes imported goods cheaper, sure, but it makes its own exports way more expensive for other countries to buy. All four of these channels combine to influence domestic demand and net external demand. Put those together, and they determine the total demand in the economy. If total demand weakens, it eases domestic inflationary pressure, which eventually leads us to our final destination, controlling inflation. It really is a massive interconnected machine. Which brings us to part 4, building central bank credibility. This is all about the driver's reputation. For a central bank to actually be effective, they absolutely must have 3 core qualities. First is independence. A central bank has to be free from political interference. Politicians are always going to be tempted to print money right before an election to create this short-term sugar-high boom. But an independent central bank acts as the responsible adult in the room, focusing entirely on long-term stability. Now, some banks just have operational independence, while others, like the European Central Bank, have target independence too. Second is credibility. They have to actually follow through on their stated policies, or no one will believe them. And third is transparency. Modern central banks publish their forecasts and clearly communicate their views on the economy, so the financial markets know exactly what to expect, no surprises. And since the 1990s, the absolute gold standard for building that credibility has been inflation targeting. This is where countries like Sweden or the UK explicitly aim for, say, a 2% consumer price index inflation rate. This is a really stark contrast to something like exchange rate targeting, where a country literally pegs its currency to another currency, like the US dollar. Doing that effectively means giving up control of your own monetary policy just to maintain that fixed rate. By targeting domestic inflation instead, central banks anchor public expectations. Because if wage negotiators and businesses firmly believe inflation is going to be 2%, they plan accordingly. It actually becomes a self-fulfilling prophecy that stabilizes the whole economy. Okay, part 5. Steering the economic engine, adjusting our speed. It basically boils down to 2 main stances. You've got expansionary policy. This is when the economy is sluggish, so the central bank hits the gas. They lower policy rates, make borrowing cheaper, and inject money to stimulate growth. Then you have contractionary policy, which is the exact opposite. If the economy is overheating and inflation is soaring way past that 2% target, they pump the brakes. They hike up rates, restricting the money supply to cool things down. But how do they actually know if a rate is objectively high or low? Well, they compare it to what's called the neutral rate. You can think of the neutral rate as the perfect cruising speed. It's a rate that neither spurs on nor slows down the underlying economy. The formula is beautifully simple. The neutral rate equals the economy's trend growth plus the inflation target. So let's say an economy naturally grows at 2.5%, and their inflation target is 2.0%. That makes the neutral rate 4.5%. If the central bank sets their policy rate above 4.5%, they are explicitly applying the brakes. If it's below that, they're hitting the gas. Finally, part 6, the limits of monetary policy. What exactly happens when the brakes fail? Because look, the driver doesn't have magical powers. One major limit is a broken transmission mechanism. Remember all those dominoes we talked about earlier? Sometimes they just refuse to fall. The central bank might slash rates all the way to 0 to stimulate growth, but if commercial banks are panicked and simply refuse to lend out that cheap money, the real economy never feels the benefit. On top of that, in an open economy, exchange rates might be heavily driven by foreign capital flows rather than domestic interest rates, which can completely neutralize whatever the central bank is trying to do. And that brings us to a really crucial realization. Monetary policy doesn't happen in a vacuum. It interacts constantly with fiscal policy. Now, fiscal policy is controlled by the government through taxation and spending. When monetary policy hits a total wall, say the central bank has lowered rates as much as humanly possible, but the economy is still just completely stalling out, the monetary driver needs the fiscal mechanic to step up. The government might need to directly increase its own spending or cut taxes to jumpstart aggregate demand. Which leaves us with one pretty terrifying, provocative question to think about. What happens when a stalling economy forces nominal interest rates all the way down to 0, and they literally cannot go any lower?